Well, thank you everybody for the invite and for having me. It's a pleasure to be here. As Jerry mentioned, I did fly in from North Carolina. I'm based out of Chicago, but they let me work remotely at guaranteed rate, and that's where my home is. I've been living there for some 30 years. I've also been in the mortgage business for 30 years. I have a lot of forward experience, but for the better part of the last almost 20 years, I've been focusing very heavily on the reverse space. So I just want to say in advance, I've heard it all before. My feelings cannot be hurt about reverse. I just want to let everybody know that I have a very special client or clients, my own parents, that have given me permission to talk about it. I love them dearly, and I did one of these for them. So one time I had somebody say, "Would you do it for yourself? Do you have one? Would you do it for your parents?" So yes, I did it for my parents, and they're very, very much loved by me and my sister. So very, very much delighted to be here. We have a pretty small, intimate group. The goal here is not to get through this deck and just read it to you. And feel free to interrupt me as we go, because sometimes you have a question and then you're thinking about that question, and the next piece maybe builds on that. So feel free to interrupt me in a group this size. Home equity conversion mortgage for purchase. Okay, that's where I wear this silly little pin. It says, talk with me about H for P. Home equity conversion mortgage for purchase is what H for P means. It's just an acronym. Home equity conversion mortgage is the FHA nomenclature for a reverse mortgage. It's an FHA insured loan. Okay, and it's called a home equity conversion mortgage, also known as a HECM, HECM. And for purchases, we call it HECM for purchase. We're in the banking business. We're very special. We have to have tons of acronyms, right? Just the way it works. Okay, so we're going to talk about how you can add HECM for purchase to your arsenal to help your clients. All right, just as a little background and baseline, some of you have seen these metrics before, but I just want to point it out. This number right here, $12 trillion, that's the amount of estimated equity nationally for people 62 plus. To get an FHA insured HECM, home equity conversion mortgage, and or H for P, one homeowner or buyer has to be at least 62 years of age. Okay? I qualify for my first HECM in about 18 months. I can't wait. I have 7 kids. I have grandkids. I still have one at home. There's lots of expenses. Okay? So 12 trillion locked in. You may or may not know that that's a little bit more than half of the annual GDP of the United States of America. It's a big number. The total equity for all people, including 62 plus, just everybody from 18 on up, is about 30 trillion. So over a third of it is for these boomers. Okay, it's massive. But this number is startling to me. The median retirement savings for baby boomers outside of equity is only 200,000. There's a lot of people that have more, and there's people that have less. This is the median. And what we do is we help bridge the gap between this and this by monetizing a portion of the home equity. Folks, there's 55 million of us, almost 56 million of us, 65 and over. Over the next 3 decades, it's projected to go up to nearly 100 million. These are massive, massive numbers. And this is why Guaranteed Rate has decided, they looked at this. Our founder and executive management team looked at this and they said, we want to get ahead of the curve and get in this space. Now's the time. Okay? It's been a very niche business up until this point. Okay, this is an interesting stat. 39% of all home buyers are boomers. Okay? I'm a boomer. Some of you are boomers too. The most of any generation. And boomers like to use an agent. I know I do. I like the personal touch. I like picking up the phone. I like meeting with the people I do business with. Okay, really neat stats. And by the way, you folks are going to get, just at Jerry, whoever invited you, will get you this deck after the presentation today. I'm not going to read each slide verbatim, but this one I am. What is a HECM for purchase? A home equity conversion mortgage, or HECM for purchase, also known as H for P, okay, is a federally insured, non-recourse FHA loan for people 62 plus. H for P allows clients to buy a new primary residence financed by a reverse purchase money loan at the time of purchase with just one transaction. The old way, you had to buy a house and then get a reverse and have two transactions. Now, and it seems counterintuitive to a lot of professionals, now you could do it all in one transaction. You could buy a house and take out the reverse mortgage at the same time. Okay, the unique benefit of H for P is that it doesn't need to be paid back month after month. Buyers have the flexibility to pay whatever they want when they want, and most choose to pay the balance at the end of the loan term. I am done telling people there are no payments. I am done telling people, oh, you should think about a reverse mortgage for purchase. Because when I talk about reverse, all the misconceptions come up and I get the hand in the face. Talk to the hand, okay? This is an opportunity. It's also a challenge. No one wants to talk about reverse out of the gate. Everybody is interested in talking about a home equity conversion mortgage or an H for P with a flexible repayment schedule, okay? That's what people are interested in learning more. What's that? Oh, it's a special loan for people 62 plus that allows you to set your own repayment schedule. Folks, just because we don't charge interest, just because we don't have payments doesn't mean we don't charge interest. We charge interest. We're a bank. When I was a kid, the bank used to give away toasters. We don't give away anything. We charge interest. The client has the flexibility to repay that interest any way they wish, and most clients choose to pay the balance at the end of the loan term. It's a growing balance loan. You get your mortgage statement every month, and you see your interest charge for that month gets added to your loan balance. If you don't pay it, you've got a loan balance that's growing. That's the catch. Okay. I want to keep going in the shadow here. I'll stand over here. All right, Greg. I'm using Jerry's clicker instead of mine. All right, at 10, 12,000 feet, just some high-level benefits, and we'll get into this a little bit as we move on. Increase your buyer's cash purchasing power. That's the main one that we're going to focus on today. But there are other things we can do. In some markets, we're still building, especially in North Carolina. Builders really like this program if you can get one to think about it because it helps to increase their buyer's cash purchasing power, and they get to sell upgrades, premium lots, and higher profit margin upgrades. Market to wealthier, retiree-centric communities. If we're in the mortgage business and we're in the real estate business, we're in the insurance business, you've got to have empathy for clients, right? We're not just transactional. We're trying to help people with their dreams come true when we're helping them buy and finance a home. Okay, so with H for P too, you'll get this product under your belt. You can increase your listings. Some of us have clients that feel stuck in their house, and I want to downsize or right size. For some people, that's bigger, or at least more expensive. But they want a new home in the new season, in the next season of life, and they feel stuck in their house. If I sell this, where am I going to go? Well, they can sell their home. You can list that, and you can actually get them what they really want, which might serve them in the next, around the next bend. We'll talk more about that as well. And by doing that strategy, you can expand your listings, especially for higher value homes. Okay. You guys are going to get sick of me doing that. I'm going to spend a couple of minutes just talking about some of the myths. I like to hit them head on. Okay? People think it's reverse mortgage. The antenna go up. It's too good to be true. What's the catch? You all know the catch. We charge interest. It gets added to the loan balance. Okay? But most people don't get that far. They just think it's a reverse mortgage. There's no payments. I'm just going to take the leap. Wasn't born yesterday. They can kick me out. I lose my house. Not true. We don't go on title to the house. Anyone ever involved with a loan with a conventional transaction? Sure, all of us. The lender doesn't own the house. We just have a lien on the house. Okay? We don't get the house either. When the people sell or die and move out and the heirs sell the house or pay off the loan, we only get our loan balance back. We don't get the house. We don't ever get the house. The house is not ours. Okay? Oop. Okay, so heirs are responsible for the balance. No, it's a non-recourse loan. That's what non-recourse means. If for some reason when the house is sold, the people were actuarial outliers and they lived to be 100, 105 in the house, and if someday the future value of the house is not sufficient or insufficient to pay back the loan, The heirs are not responsible. It's all forgiven. If there's any equity released at the time that the home is sold, which is most of the time, we just get our loan paid back. The equity that's released goes to the seller or the heirs, and it's theirs. In fact, we have people that have rolled their equity in a reverse mortgage for a number of years and then go buy a different house or move to a different state. Okay? But it's non-recourse. You have upside equity release if there's equity. If there's no equity at the end of the loan term, then it's forgiven, regardless of what's in their portfolio, their estate. Doesn't matter. It's completely forgiven. I'm prevented from selling my house. No. I did a loan for a guy 6-7 years ago from Florida, moved up to my neck of the woods in North Carolina, actually in Pinehurst on the golf course there. He was a retired emergency room doctor. And now he just had a reverse mortgage for about 6 years with us. And then he retired. And then and now he just sold that house, rolled the equity. The home has gone up nicely in value since we did the loan for him. And he's moved out to Arizona to be a long-term caregiver for very elderly parents. He lives in Arizona now. We just closed him a few months ago. Okay? All right, and the heirs cannot inherit the home. Big myth. I mentioned before, I think I did one of these for my parents. I have one sister. We are the sole heirs to my mom and dad's home, and we have a reverse mortgage on it. Someday, when mom or dad die and or dad has since passed, but when mom goes or leaves the house, we'll sell the house and liquefy the equity and pay off the reverse mortgage, okay? And if my mom passes, we'll inherit the home, okay? All right, what are some basic eligibility requirements? We're gonna blow through this. One of you has to be at least 62 years of age to qualify. There's no minimum FICO score, okay? I didn't say you can have lousy credit, okay? Don't hear that. But there's no minimum FICO score, okay? There's no minimum debt to income ratio analysis for people on fixed income, okay? What we do is a simple residual income analysis. We want to make sure we're setting the client up for success. It's more for suitability, right? We have needs-based borrowers, and then we have non-needs-based borrowers. The needs-based borrowers, it's really set up for them. We don't want the federal government doesn't want lenders putting someone in a reverse mortgage that's going to kick the can down the road and set them up for a tax foreclosure, okay? Pretty easy to qualify for these things. You got to occupy the property as your primary residence, defined as more than 6 months out of the year. I have a client that called me, Greg, we're going to take our RV for 2 months. Gosh, thank you for letting me know. You don't have to tell me that. It's totally okay. You just have to live in your house more than 6 months out of the year. You can't be delinquent of any federal debt, and you have to have a counseling session. I'm just going to touch briefly on that. Look, Guaranteed Rate is very serious about bringing this product to market the responsible way. We don't sell this product to anybody, okay? We just unpack it. Nobody in this season of life needs to be taken advantage of, okay? They need to see the wonderful benefits of the loan strategy, but they also need to know the concerns and the risks, and we point those out to them. Not all lenders approach the business the same way. And so HUD, FHA, has a mandatory counseling process that requires every prospective reverse mortgage borrower to have a short counseling session with someone that knows something about this and is not a lender, thereby they have nothing to sell. Do you know your loan balance is going to go up over time if you don't make payments? Do you know if you don't pay your property taxes and maintain your insurance, you could lose your home eventually to foreclosure? You know, stuff like that. We don't just gloss over it. We talk about it head on with the clients. But everyone gets gets counseled. Once they're counseled, the lender is free to process a loan. Okay, so you can do single family residence, townhomes. We'll talk about this one slide at the end, multifamily homes, and FHA approved condos. We can also do, I don't want to quite call them a spot approval, but we do have a little bit of a shortcut on condos if we have if we need a single unit approval. And of course, modular homes. Okay. All right, so this is the big one. Expand your client's cash buying power by 33% to 100%. Basically, the older someone is, the more leverage they get. If someone is at 80-ish, they can double their cash purchasing power. Someone has $500,000, they can buy a house for $1 million and just use $500,000. I just threw that number out for easy math, right? Okay, what does that mean? Cash purchasing power. I have $500,000 cash Go buy what you want up to $1 million if you qualify for 100. If you're only 62, okay, if you're, as we say in the southeastern North Carolina, if you're a youngin', okay, 33%, you get to finance a third. So maybe you're bringing 600,000, 600-ish, 630,000 to closing, 660,000 to closing, and you're buying $1 million house. You're financing a third. You're putting down 2/3. Okay, when you're young. Okay, young in this category. Okay, all right. And then after you do that, you have optional payments. There's no mandatory monthly mortgage payment. Oh, there's another catch. You got to pay your property taxes. You've got to maintain homeowners insurance. You've got to pay your HOA if that's applicable. Okay, and you have to maintain the home to basic safety standards. You have to protect the collateral. Okay, pretty hard to lose a home when payments are not required. Yes, please.
Okay, so you got 33 to 100%. You said if you're 62, which is at the bottom of the age bracket, you're at 33%. What, like if you go from 62 to 65 to 70 to 75, at what point would you be at the 100% mark?
Well, it even goes over that. Like if as you hit 90, you can get more, and if as rates come down, you're getting more. So this slide was done when rates were like at 8%, and now the rates have come down, so it's probably more like the bottom is probably around 35%, 36%. As rates come back down, the LTV goes back up. It's not just a function of age, it's also a function of the rate environment. So when interest rates were in the dirt a few years ago, this range was around 50% on the low side. So it's starting to trend back a little bit.
And then say someone does borrow 100%, $500,000 purchase price, they get $500,000 cash they have, they buy a house for $1 million. Over time, that home's appreciating. Aren't they also getting a line of credit that they're going to be able to draw on at some point?
We will talk about that. But if they fund the full amount that they qualify for, somewhere between the third and 100%, if they fund it at the time of purchase, there is no available credit line because they funded the full amount to buy the home. If the person that has the $1 million house that's free and clear, and they do this, then they're the ones that take it out as a credit line. We're talking about the purchase strategy where we're funding 100% of what the client qualifies for at the time of the purchase, so they don't have to pay all cash.
But if they pay some of it back, then that would open.
Yeah, it would open up the credit line. In fact, in the example of someone that qualifies for wants to buy $1 million house and they use 500, if they want to use more, if they want to use 700 and only borrow 300, when they close on the purchase, they'll have an automatic $200,000 credit line if they've overfunded the loan. If the requirement was 50% and they brought 70%, then that 20 would just be in a credit line, which grows. I don't mean to get off tangent with that. That gets a little complicated. I'm going to illustrate that for you in a moment. Okay, so I love this slide. I'm not going to dwell on it, but it's near and dear to me. This is a client of mine. Okay, it's not her real picture. It's not her real name. But everything here is the real deal. We closed her in May of this year. Okay, so Mary's 64. She has $740,000 in savings. She wants to buy a new home for almost $700,000. There's the contract price, $683,750. Mary qualifies for a conventional loan, but she wants to retire in 3 or 4 years. And once she retires, her income will drop substantially down to Social Security. At age 64, she can borrow, when we closed her in May, 38%, almost 38.5%. Okay? So a little bit more about Mary. Mary's from southeastern North Carolina. For the last 11 years, she's been living just north of New York City, renting an apartment, missing her family. She's a single woman. She's never had kids, but she has lots of family in southeastern North Carolina, and she wants to set up her life to move back to North Carolina, which she has successfully done. Her company is letting her work remotely, and she's already made the move. She's left New York. She's home where she wants to be, and she didn't have to spend $740,000 in our market. That's a pretty good value home where I live. Okay, but that's what she wanted. So Mary didn't have a house anymore. She had the savings. She also has, I didn't complicate the slide, she has about $300,000 in 401k. Okay, so she's got over $1 million. Some of it's taxable IRA. Okay, but that's what she has in savings, $740. Okay, and so she could have purchased this home. She qualified for about 50% because see her DTI is just under 45%. She could have borrowed half and got a traditional mortgage, and she could afford the mortgage payment. She could afford that. She's paying rent about that much, and she could have paid that in a mortgage payment, but she wouldn't have seen the ability to retire in 3 years. Okay, how am I going to lose my income? Okay, how am I going to deal with this payment when I lose my income? And her current income is at $7,300. Her actual, that's as if she took her Social Security. We needed to do that to qualify her for a conventional loan. She hasn't actually done that, but for illustrated purposes, we put it on the slide. She would have needed to do that to qualify, to get her to qualify for as much as we did, 50% here. Okay, so this was an option, not a desirable option. Her other option is to pay all cash. Okay, she paid all cash. She's got the money, but that would have taken her savings down to $56,000. That made her feel big old frog in her throat. Okay, she thought, okay, I do have my 401k. I'll be adding to that for a few more years, and then I can just aggressively save and add to the piggy bank. So that was a possibility. What she ended up doing was H for P. Okay, surprise, surprise. So she made a sizable down payment, $445,000. She borrowed this amount, $262,000, and she had almost $300,000 left in savings. That's what she did. Okay, so she drained her savings quite a bit, but she doesn't have a mortgage payment. Between her savings, her 401k, and her income, she's able to live and save, and she's advanced her goals and objectives by 3 or 4 years. She was going to wait and live up there another 3 or 4 years. She realized, I'm not getting any younger. Her nieces and nephews are growing up. And the other thing is, her realtor told her, maybe you shouldn't spend that much money. Her financial advisor told her you shouldn't spend that much money. Maybe buy something a little bit more modest in North Carolina. She didn't want something more modest. She wanted this. There's subjective value there. There's subjective value there, right? You were thinking the same thing. Don't buy that much. But she wants a place on the outskirts of town with 10 or 11 acres. She wants ponies again like she had when she was a kid. She wants her family to congregate at her house. That's what she wants, okay? And she can always sell this place, pay it off, and do something else. But she's in the house now. She did it with H for P. Mary is not a needs-based borrower. Mary never would have seen a commercial with Tom Selleck and said, oh, I need to think about going for a reverse for purchase. No. Her agent is a referral partner of mine and said, look, Mary, if you really want to spend $700,000, just call Guaranteed Rate here in Wilmington. Call Greg, and we offer them conventional option. Okay, we talked about the all cash, and she ended up selecting this. Are you kidding me? I'm not a reverse mortgage customer, is what she said. My parents said the same thing to me 11 years ago. We're not reverse mortgage people. I still don't know what that means, but they are now. Okay, delightful story. I love this slide. Okay, I'll figure this out before I leave. Okay, all right, so we're going to talk about an upsizing and the next slide, a downsizing. We will not spend nearly as much time on this slide as we did on the last one. Okay, these folks, 70 years of age, they're in Florida, $500,000 home. They want to upsize to $650,000, okay? And we're going to use the same metrics for a downsizing scenario. $500,000, $40,000 in transaction costs. I know that's high, but there's moving. We like to be conservative, okay? They liquefy $460,000, okay? The new house is $650,000. That leaves them $190,000 short, okay? They wanted a different house. The house was more expensive, okay? They wanted to move to a house that would be more suitable for them in the next season of life, okay? So now they either have to dip into savings to facilitate their goal if they don't use H for P, and come up with $190,000 or finance it if they qualify, okay? So what did they do? They used H for P. It's the same thing. They liquefied $460,000, okay? They paid the same amount, $650,000. They used H for P. They did a $260,000 loan. There's their down payment. Instead of being short $190,000, they added almost $68,000 to their piggy bank. I mean, that's what they did. Well, Greg, but here they have a loan. Here they use their savings or cash. Yeah, that's all very true. Okay?
But they were short almost $200,000.
Yeah, but they got the house they really wanted and they added to their liquidity. I mean, what's the catch is they have a loan. They have a loan where interest is being charged. They have the ultimate flexibility in how they repay that interest. Most people wait till the end of the loan term and then it gets paid off when they sell. But you don't have to. There's no prepayment penalty.
So can I ask you a question?
Sure.
If they like, let's say they prepay on the balance, like you can do on a car, like
Yeah.
you can do on a home equity line of credit. If
Right.
they prepay the balance, that's going to reduce the interest that they're going to pay in the long run,
Correct.
right? But they could decide they want to pay $100 a month or $500 a month, or
Sure.
whatever they're comfortable
We have
with.
many clients that do that. There's many clients that say, I don't want to spend $2,000 a month on a mortgage payment, but I'm okay spending $500, $600, $1,000, whatever the number is. And it's like a sinking fund. It's not a one-way sinking fund because with the reverse mortgage, if we set it up correctly, you can pull it back out later. You can pull it back out later. And we'll talk about this as well shortly, but not only can you pull it back out, the amount that you put into it actually grows and compounds for you over time. It's wonderful. It's like goes crazy. It just my head exploded when I learned about that 20 years ago. So anyway, we'll talk about that in a minute. Okay, so here's a downsizing scenario. It's the same sort of scenario. Okay, same numbers, 500,000. Except instead of going up to 650, they're going downsized to 350. Downsizing with all cash, the same metrics. They liquefy 110,000. If they use H for P, instead of 110,000 when they downsize, 253. Just substantially more money to add to the retirement portfolio. Am I the only one here that doesn't know to how long we have to plan? I mean, it would be so nice if we knew the exact date or month and year for how long we have to plan. I've been serving clients in this segment for so long, and I'm quickly one step into the demographic myself. We don't know. We fear running out of money more than we fear dying. We don't want to be a burden to anybody. I don't want to be a burden to our 7 children. Yes, did I say 7 children? They've been a burden to me. I only have one left in the house, so I get to start saving soon. I can't wait till I qualify for a reverse mortgage. Okay, 18 months away. So downsizing in this scenario, they just add more to their liquidity and their savings. Okay. Okay, we just talked about the H for P strategy. Now we're just kind of the reverse for purchase money loan. Now we're just going to talk about what are some other ways your clients or selves can use a reverse mortgage in retirement, okay? For those that aren't purchasing a home, that want to stay in their existing home, there's a lot of data out there. Most people prefer to age in place, given the choice, okay? If you have a mortgage in retirement or beyond 62 plus, the number one way we use a reverse mortgage, a traditional reverse mortgage, is to simply refinance a conventional loan and pay it off with a reverse mortgage. You still have a mortgage, but you don't have a mandatory monthly mortgage payment. It's probably the number one way that people can increase their cash flow in retirement without putting their home at risk of losing it. Okay? That's number one. The other way is to just set it up as a credit line. We're talking about that next. Kind of like a HELOC. Think of it as a reverse HELOC. It's just for a rainy day. Okay? That's the backup reserve fund for any purpose. There's a trend now, people are setting it up, the reverse credit line, and drawing on it to help younger ones in the family with down payment assistance for their first home. That's a really clever way. Do I want to, my mom's 80, almost 84. My dad passed 4 years ago. My mom has a reverse mortgage. My mom is using, their house was free and clear. We did a credit line, and now she's been getting income from it. She owes a couple $100,000 on it. After my dad died, she needed income. So, anyway, we want my mom to use that credit line. We don't want her to die, so we get her equity, what's left of it. Right? So my mom can help. She's not, I already have a house, so does my sister, but maybe a grandchild. If she wants to do a 3.5% down, help with him to get an FHA loan, she can do it. She's told me, I want to enjoy giving some of this while I'm alive and can enjoy the benefits of giving, to see that and not having that sort of tension. It was small, but it was really nice. My mom, affectionately known as Gigi to our kids and grandkids, my daughter just spent a semester in Barcelona, and I made her work all last summer and the summer before to save up for it. Okay, Grandma went over there with a $1,000 little goodie check that she got from her reverse mortgage. Just brought her joy. Here's an extra $1,000 fund money for your semester in Europe. Okay. The other way we use a reverse mortgage is tenure payments. That's what my mom gets. My mom gets $1,700 a month tax-free from her reverse mortgage, because that's what my dad's Social Security was. And when he died 4 years ago, that's the amount that he got. So Dad knew he was going to die. He turned it on. They had not drawn on it when they took it out. The credit line grew for 7 years. And then just before he passed, he bought her a car, $30,000-$40,000, and then turned on the income for life. So my mom gets that income. She wasn't forced with, what do I do? Will I have enough money? Will the money in the IRA, what are the tax consequences? She only takes the required minimum distribution from her IRA, and she gets tax-free tenure payments. Folks, I'm not being flippant about this. My parents gave me permission to talk about it. Not just today, just in general. Okay? It's not what everybody thinks. It's served our family so well. Okay? And next, we're going to just talk about this standby credit line, where people use a reverse credit line in coordination with their portfolio to extend the retirement runway. It is absolutely brilliant. What I'm about to show you does not come from the bowels of the reverse mortgage or mortgage industry. It comes from the Journal of Financial Planning. So here's the setup. We're going to talk about Ernie and Rose. This is perhaps the most exciting part for me to share with you, the next couple of slides. And then we're going to we have 2 more examples, and then we're wrapped and we're done. Okay, so here's the scenario. Ernie and Rose retire at 67. They are not in the needs-based bucket of borrower. Their portfolio is $900,000 at 67. Okay, their plan is to draw $50,000 a year from this, in addition to their Social Security income. And when they retire, their house is $600,000 free and clear. I want to be Ernie and Rose. Okay? Okay, we're using this example because Ernie and Rose are part of what we call the mass affluent. They're not uber rich. They're not Elon Musk. They're $5-10 million. But people that have net worths $500,000 to $2.5 million, including home equity, we would put in that mass affluent bucket. Certainly anyone that has $500,000 or more outside of home equity is considered in that mass affluent bucket. It's a loose term that financial planners use. There's a lot of people in that group. Okay, so how would they use a reverse mortgage? There's 2 main ways to use it. One is the old way, which we all thought, which I thought many years ago. Hey, use it as a last resort. I don't need one now. If I ever need one, I'll use it as a last resort. I'll draw from my portfolio and savings. Okay? Or you can use it in coordination with portfolio withdrawals. Okay, so this could look disturbing, right? To just look at all these numbers. What is he going to talk about now? My head's going to explode. I'm just going to put some highlights here. If we used it as a last resort, remember Ernie and Rose retire at 67, and we started in 2002 when the market got hammered because we wanted to try to break this strategy, and we couldn't break it. They have $900,000, remember? Welcome to retirement. They take out $50,000, and the market goes down. Their portfolio goes down by $210,000 because the market gets hammered that year. This is just the S&P 500, folks, to just use a broad bench market analytic. Okay, so it's no financial planners call that sequence of returns risk. When I stop working, my income goes down. I go into retirement, and my portfolio gets hammered. If anyone's ever had a portfolio that's taken a hit and then you have to draw on it again, it never comes back because you're hitting it while it's down. Okay? And so we live in the real world here at Guaranteed Rate. So with Ernie and Rose, when they were 67, they wanted to take $50,000. We've increased that by 3.5% per year just to keep up with expenses. So you can see we didn't keep it static at $50,000. By the time they get to 84, they're taking 86,000. That's the power of compounding at 3.5%. So their income needs go up. Their income needs in 2002 are different than they are in 2017. It's just because of inflation and cost of goods. All right. So what happens is the long story short here is that I've highlighted the down years or the flat years in red. Okay. But these folks run out of money. Their $900,000 portfolio runs out by the time they're 84, and then they start drawing on home equity, in this case a reverse mortgage, as a loan of last resort. Their planner collected 1% fees, the assets under management, over the course of that time. As the portfolio dwindled, their 1% fee went down, and now at the end, there's no fees anymore for the planner because the client doesn't have a portfolio. That becomes a pro bono client if you're a good planner because you have a relationship with the people. Anyone but me ever done pro bono for our clients? Okay, so anyway, this is the scenario where they run out of money if they live that long. But what if retirees could more safely increase their income withdrawal rates, improve portfolio growth, and reduce risk at the same time? This is where real skeptics will throw rotten tomatoes at me right now. The coordinated withdrawal strategy with a standby reverse line of credit can do all this while reducing the impact of volatile markets. Here's the strategy, folks. It's very simple. We alternate between portfolio and the reverse credit line. What drives that decision? We establish the reverse credit line on the first day of retirement, early, at 67 for Ernie and Rose. Now, folks, when my parents took out their credit line, it was about $330,000 back then. That credit line limit has gone up. It's almost doubled since they've taken it. With the reverse mortgage credit line, the credit limit is ever increasing month by month. People say, I only get 33% of my house value when I take out the loan. I only get 50% if I'm older. No, that's just what you get at closing. We at the time that you take it out, the credit limit of a reverse mortgage credit line goes up month after month, quarter after quarter, year after year. At current growth rates, the credit line is doubling in about 10 years right now. Okay?
Because the value goes up? Or?
No, it has nothing to do with the value. If the value of the home goes to zero, I want to make this point and be absurd. How's the house going to go to zero? It used to be on a golf course. Now the golf course is a garbage dump. Okay? The house is worth zero. That credit line still continues to increase because all the risk of this program is offloaded to the lender and backed by Uncle Sam under the right thinking that as people age and continue to age in place, they presumably can take on less and less risk. Okay? All that risk is offloaded and insured by Uncle Sam. Okay? So we established the reverse credit line and let that credit line grow. Remember I said my mom started taking the $1,700 a month? Well, that credit line grew for 7 years. Then we turned it on for income when my dad was going to lose, when my mom was going to lose hers and inherit my dad's. Right? They lost one Social Security. So you let that credit line grow. Then at the end of the year, you evaluate the portfolio performance. If the portfolio value has gone up, take it from the portfolio. Your annual income draw, the 50 grand for Ernie and Rose. If the portfolio value has gone down, take the next annual draw tax-free from your reverse mortgage credit line. Now let's take the same data set, the same starting point. Ernie and Rose, 900,000. They look a little older here, okay? 67, started in the same bad year. We have this bad year. We have a 1 in 100 year anomaly, which planners don't like to talk about. Okay, we included it. That was the financial crisis. 39% on the market was down. Okay, and then here we were down in 2022 a good bit. The portfolio got hammered again. The only difference here, folks, remember the 50,000? Instead of taking it and then using it all until it exhausts, after the down year, the next draw comes from the reverse credit line tax-free. Down year, reverse credit line tax-free. Flat year, take it from the reverse credit line. Down year, very, very small down, take it from the reverse credit line. Instead of waiting to take it from the reverse credit line, by the time these folks are 86 by doing this, they still have $750,000 in the portfolio. And then in 2022, the market's down and that portfolio is down to 505 with an almost 20% hit. They have money. They still have money. It's all they did differently was stagger when they hit the draw instead of using it as a last resort. What the Journal of Financial Planning has done is tested this with all kinds of Monte Carlo scenarios. The guys that like these academics like Wade Pfau, Jamie Hopkins, Phil Walker, Barry Sachs, they're all published. No one knows about this. Advisors are just beginning to know about it. Just because it's published in the Journal of Financial Planning, they still don't get it. It takes a generation of new possibility thinkers to see this. It's like I've got this little secret no one knows about, but yet you get the hand in the face. Folks, no financial product or service is good if it's applied wrong. Are annuities good or bad? Well, it just depends on how they're used. Is a reverse mortgage good or bad? I'll tell you when it's bad. These people really want to sell their house, but they need a reverse mortgage to make ends meet now until the house is sold. Well, that's an expensive way to get your hands on some short-term equity. Don't do that. Okay? I need to have as much equity in the house later because my life plan is to eventually sell here, have as much equity as possible so I can move to Texas where I have family. Well, the reverse strategy might be counter to having the most amount of equity later. That you want to guide your client. You have to think about that. Unless if you're not making mortgage payments, you're aggressively saving and investing so you can facilitate your life plan later. All I know is this math is amazing. Please look at this on your own time when you get this deck. It's the same data set. The outcome is unbelievably better. Unbelievably better. Okay, so recapping. Ernie and Rose run out of money at 84. Okay, the portfolio goes down to zero. At 87, 88, they still got $500,000. By the way, this number's going up this year because they would let the portfolio rest this year. The market, this S&P 500 is from this year is up about 19%. Yes, ma'am.
So is the financial planner advisor they're directing which one is coming from which direction? Who's giving this advice?
Well, so yeah, we get the planner on board, but the advice is the advice is very simple. Set it up early, evaluate the portfolio at the end of the year. The portfolio has gone up, take the money from the portfolio. If the portfolio has gone down, take the money from the reverse credit line. It's just a very simple strategy.
The other thing, because the portfolio value is so much higher and lasts so much longer, the financial advisors will be making a lot more money on longer term rather than it being exhausted so much earlier. Now the financial advisor is completely out of it, not making any, they usually make 1% a year.
Yeah, I don't like to highlight that so often. That's a very good point for the planners when I'm speaking to planners because they're like, they don't want to be anything transactional, the good planners. This is just cherry on top, but it's real. Everybody's interests are aligned here. The planner still has The advisor still has a client and still money under management as opposed to running out of money over here at the dwindling portfolio. The planner collected $76,000 at 1% under the last resort strategy, but years after this expired, they've collected $134,000 in fees at 1%, and they still have a portfolio to manage. It goes on. I mean, one thing happens at some point. Ernie and Rose don't stay in the house. Ernie and Rose don't live forever. But no one knows to how long we have to plan. At least Ernie and Rose don't have to have decisions forced on them. They can make their own decisions, not driven by we're under a cash crunch.
So you're my financial planner. We talk about the fact that I'm going to do this, and then we get together every year and have a conversation. Say the market's down. Let's take out of your line. The market's up. Let's take out of your portfolio.
Yeah, and as a tangent to that, some folks like my own mom, her IRA that she inherited from my dad is taxable IRA. So we have something called an RMD, which many of you are familiar with, which is a required minimum distribution. It doesn't change the strategy. What we do is we take the required minimum distribution, and then the planner just invests that in a separate account. We're still drawing from the credit line, right? We're not drawing from the required minimum distribution and spending the money on living. We're reinvesting that money.
Frank, can you explain, not everybody can get a line of credit with reverse mortgage. You may be able to get a reverse mortgage and just not have any extra equity to start the line that has that growth rate, which is the awesome piece.
Okay.
You could buy a house with reverse mortgage and you may just have just enough money to get into that and avoid making monthly payments, right? But if you have additional equity, you would put it in the line, and that is that fabulous growth rate that you would use in tandem with your asset.
Okay. So thank you for making the point, because the reverse mortgage lending spectrum has very different applications. So just to kind of put them in separate compartments, the first one we discussed today was to buy a house. So we know what happens when you use a reverse purchase money loan to buy a house. You take your full benefit up front to buy the house. So you don't have any credit line left over. Okay, you used your third or your 50% to buy the house. There is no credit line for you to access. Under another example, if someone just stays in their existing home and has a mortgage now at 40 or 50% equity of 40, 50% of the home's value, then we could use a reverse mortgage to eliminate that mortgage. They don't have an additional credit line, right? But then we also talked about the other compartment, which was Ernie and Rose, and it also happened to be my parents. My dad was a very good breadwinner and very successful in business. And I can tell you folks, he retired at age 49. He had a really bad heart attack. He didn't think he would live till 60. And he just retired early to spend time with my mom. And he ended up living till almost 80. But what happened is he learned something very difficult. Just because he was good in business doesn't mean you're good at trading stocks. And I know how to make $15 million day trading. I really do, from my dad's mistake. You got to start with 30 million. Okay. You know, it's a bad game. Okay. My dad was very embarrassed about it and felt very bad. He basically lost all their savings except their and investments, except their high taxable IRA. And he had a nice luxury home, free and clear. They sold it, they downsized, and they paid $700,000 for a little and a golf course, a little patio home, okay, in a high-end community in southeastern North Carolina. They went from top of the economic food chain to, okay, we better just hold on. And that's when I came in and put the reverse mortgage credit line on for them. But to your point, I'm sorry to get so personal, but it means something when it's personal. Okay, the numbers are irrelevant, whether it's a $700,000 house, a $300,000 house, the percentages are the same. The strategy works the same. So the last example that you touched on was, how does that credit line work? Those that get a reverse mortgage credit line when their house is free and clear, they get the most bang for their buck by monetizing a portion of their home's equity, like Ernie and Rose. But there are some people whose homes are not totally free and clear. Ernie and Rose could have had a $600,000 home with a $100,000 balance left at retirement. You know, they've been paying on their mortgage for a number of years. There's still $100,000. Or maybe they took out a HELOC along the way to help some kid get out of jail, right? I mean, you know, there's all kinds of reasons why people still have debt at that season of life. So what we do in that case is the first proceeds that are used from the reverse credit line, if people qualify for a $400,000 credit line and there's a $100,000 loan balance, we pay off the $100,000 loan balance and the rest gets put in the credit line. Okay, that's how that works. So we just kind of compartmentalize. We're using a reverse purchase money loan to fully fund a purchase so a client does not have to pay all cash or get a traditional mortgage. Or we're staying in our existing home and we're using the reverse mortgage to pay off an existing loan and eliminate the mortgage payment. Or we have a free and clear home or a home with a small mortgage balance and we're using mostly the reverse credit line. And we are big believers under my leadership at Guaranteed Rate. I train everybody this way. Do not try to convince anyone to over leverage themselves. You know who it's good for the more money you borrow? Your lender. Would you folks rather sell $1 million house or a $100,000 house? Would we rather make $1 million loan or a $50,000 loan? Okay? This is a protected class of people. I counsel our clients and all of our salespeople and reverse specialists, do not convince people to take money out and put it in the bank and accrue interest. Just leave it in the credit line growing for you. It's like cash. It's like cash with a return that's so much better than having it in a savings account or checking account. So, and by the way, with the federally insured loan from Uncle Sam, you know, I had I don't know if anyone's ever heard of SunTrust. I had a really nice credit line on my house years ago when the financial crisis hit and I wanted to use my credit line. And guess what the bank said? We've changed our appetite. We don't want to extend that credit anymore. Well, let me tell you what happens with these loans. As Ernie and Rose go from 67 to 87, if their lender has gone out of business, Uncle Sam comes in and makes good on the commitments. Okay? You don't lose it. If you had a traditional HELOC and the company goes out of business or loses its appetite to extend the credit or says it's after 10 years, there's no more draw, the credit line's not growing, and now you have to make a payment, or now we're going to do another appraisal, we've lost our appetite, pay it off, okay? Doesn't happen with this. People can't take that risk as they age, okay? So how does HECM compare to conventional financing? Okay. There's an age restriction. Someone's got to be 62. You're allowed to have a non-borrowing spouse under 62 that's fully protected. That's all I'm going to say about that. We can talk about that offline, okay? But at least one borrower has to be 62. With conventional, there's no age restriction except the legal age of 18, okay? And technically, you can have a non-borrowing spouse down as low as the legal age of 18. I personally will not professionally. I just refuse to do it. If you're 62 and you have a non-borrowing spouse, 18, get someone else to do it. I did do an 84 and a 42 once. That was interesting. So no monthly payments are required under the HECM, because the HECM increases flexibility and increases liquidity every step of the way. With the conventional loan, you don't have flexibility, but you do have increased equity. We all know this. As you make payments, part of your payment goes toward principal. And at the end of the amortization table, more of your payments going toward principal, and because you don't have a big loan balance anymore. So here, there's nothing wrong with this. You just have increased equity, but you don't have the flexibility. Here, it's all about liquidity, tax-free liquidity. Okay, so there's minimum DTI and FICO score requirements on this side, but not on this side. Here's the catch, folks. The loan balance rises over time. The loan balance decreases over time. Here we have liquidity increase. Here liquidity decreases.
But that's only because on the right side, they're having to pay principal and interest. So if they pay principal on the left side, then their balance can go down too.
Sure, absolutely. You have the flexibility to do that. You just have, you're in the driver's. Imagine, go see guaranteed rate and get a 15 or 30-year loan for your purchase. Just get a traditional loan. And imagine if the guaranteed rate loan officer or VP said, okay, well, interest rates have come down. They were 8%. They're down to 7.25%, 7 3/8, whatever they are right now. What would you like your payment to be? No one does that. Here with this, you decide what you want your payment to be. I want it to be 0. I want it to be $500 a month. I want it to be $1,200 a month. You just decide. And every month, you get your mortgage statement, and you can look at it, and you can file it away, or you can make a payment and file it away. If you made a payment the previous month, you'll see your loan balance came down. And the money that you made, the payment that you made, flowed right into your available credit line. You watch your credit line go up. Yes, ma'am?
I do want to go down the rabbit hole.
Yep.
If the older spouse passes away, the younger spouse is refinancing?
No. Okay. So if anyone looks on the internet and sees anything about this, of a horror story, just know that it's old. Old. It was fixed in 2013. Okay, with the passage of the new Reverse Mortgage Stabilization Act, okay? So here's how it works. Someone's 65, non-borrowing spouse 55. They live for some period of time. It used to be that the non-borrowing spouse had to come off title. Doesn't happen anymore. It used to be that if the borrowing spouse died, the loan had to be settled, okay? That doesn't happen anymore. What happens now is the loan has a maturity event, but instead of having the standard 1 year to sell the property and pay it back, there's up to a year doesn't have to be a fire sale. And there's going to be a business in the future for understanding this product basically to help families liquidate and sell homes that have reverse mortgages on them, where some realtors are like, oh my gosh, we don't know anything about that. What do we do? We can talk offline about that. It's not that hard. You just have to understand the process. You can maybe market yourself and get those listings in the years ahead. But in any event, I got a little off track. So the under 62, what happens is when there's a maturity event, instead of having up to 1 year to pay off the loan and get it off the books, it's in perpetual deferment as long as the eligible, protected, non-borrowing spouse maintains some very basic obligations of the borrower. Live in the house as the primary residence. They had to be on the loan. They had to be living in the house as their primary residence when the loan was taken out.
Would they be on the title?
Yeah, they could allow to stay on title. They have to maintain the taxes, insurance, HOA, and maintain the home. That's it. If the 62 dies at 65, 3 years later, proverbial hit by a bus, and that 55 is now 57, 58, and lives to be 100, that's fine in perpetuity.
So that 18-year-old's living there for.
Yeah. Yeah.
That'd be an interesting case to study.
Yep. All right. So, what's the catch? Is it too good to be true? You all know. We've already talked about this. That's the catch. The balance rises over time. It's a growing balance loan. Folks, I've been doing this a long time. I've heard a lot of people presenting, and it's, oh, there's no payments. There's this, and it's like we as loan officers, that once we understand this product, when professionals flip the tipping point and say, oh my gosh, it's not what I thought it was, then we project what we think to everybody else. But everybody else gives us the hand because they don't know now what you know. You now know more about this than most financial advisors. Okay? It won't always be that way. The wave is coming. And you folks are in positions of influence. I know you are with your customers. You're not like me. You're not a financial advisor. It's above my pay grade. Okay? You're not lawyers. Okay? Maybe there's a CPA in the group here. Okay? I'm not. Okay? But what happens is there's still people that come to me. I've been a mortgage guy for 30 years. I have people and family, friends, they think I'm some kind of finance guru. The truth be known, I'm not even that good at math. You're in positions of influence, and you don't have to explain this product to anyone. And you shouldn't use the word reverse. You should memorize, home equity conversion mortgage for purchase might be an option to consider amongst the other conventional options. Go speak to our friends down at Guaranteed Rate. We will lay it out. It's just an option. Even when they come to us, because look, Jerry's certified in this. We have an internal class that we give to everybody, and we have thousands of loan officers in the Guaranteed Rate companies that are working on their certification. Oh, you're all certified? Thank you. Thank you for telling me. Sure, you guys in this branch have been adopters, and that's one of the reasons why they sent me out here. Okay, and just because our loan officers who are very experienced are certified, our owner does not want our well-intentioned, very experienced loan officers to go to school on clients with a new product. So we actually have reverse specialists, not just processors, licensed reverse originators walking with them behind the scenes. It's very expensive for our company to do this. It's very expensive to have 2 loan officers on a loan. One of them's a shadow behind, just to make sure that we're not going to step in a minefield. Okay? And they have these wonderful processing pods that take things from cradle to grave that you're used to, but our team actually processes the loans too. Okay? Know that Guaranteed Rate is the only company that I know of that is doing it this way, and is doing it because our reputation is so important to us. Yes, ma'am.
2 things that come to mind. So, can you explain how you can buy into a reverse mortgage? Because, when I turned 62, I did that. So I didn't have enough equity. So I was able to go to another, asset source that I have and
Okay.
put money to the closing table to eliminate my mortgage payment.
Sure. I'll be happy to speak about that. So let me use, just for easy math, the $1 million example and $500,000. You qualify for $500,000, the 50%. It's very easy to follow. Okay. So your house is worth $1 million. You qualify for 500, but what if you owe 600? You better sell and do something else with the 400. You can do that, but in this example, people this want to stay, right? So the house is worth $1 million. They qualify for $500,000, but they owe $600,000. Doesn't mean you're not qualified. You're qualified for $500,000. You can go to another savings bucket and cure that shortfall at closing, so you can live in your $1 million house and not have a mortgage payment. You can wipe your hands of the mortgage payment. Okay? So the example that you just brought up was like, well, what if I only qualify for X percent, say 40%, but my mortgage payoff is 50%. I'm 10% short. You could just bring 10% to the closing table, and now you're done. You could stay in your house. You didn't spend the money and lose the money. You just moved it from one side of your balance sheet, savings, portfolio, investments, to another side of I had one client sell a really nice RV for like $50,000-$60,000 and use that to cure their shortfall because they weren't even using the RV. So yeah, it's
And you're going to get, like a lot of times people don't realize, how do you come up with the number that I'm entitled to? So that's the reverse mortgage calculator.
Yeah.
And every lender is going to come up with the same number, right? It's a calculator.
every lender comes up with the same number because we're using a HUD table, and it's based on age, and it's also based on the current interest rate environment. So it's not so like, oh, this program's 3.5% down, this one is 20% down, this one's 5% down. Doesn't work that way with reverse. There's a number of variables. The main drivers are home value or purchase price and age of the youngest borrower or age of the youngest non-borrowing spouse who's protected. That drives these calculations, but there's an overlay to that, which is the interest rate environment. So as interest rates go up, the LTVs get compressed. As interest rates go down, the LTVs get bigger. But these guys all have access to those calculations. Yes, ma'am?
I'm jumping ahead, but just curious about the difference in interest rates on your conventional 30-year loan to a reverse.
They're about the same. Yeah, they're about the same. These used to be part of the FHA Ginnie Mae pool, but now now the industry is matured enough. It's got its own pool, which is called an HMBS. It's a HECM mortgage-backed security, but the DNA is Ginnie Mae. Yeah, so it's like FHA pricing, and the credit line is all credit lines go up and down with the market. Yes.
What about closing costs?
The elephant in the room, the closing costs. These things are brutally expensive, aren't they? Look, these loans cost more money than conventional financing, and depending on the scenario, the average range is somewhere between 3% and 5%. So we'll call it 4%. It just depends on the home value. If you have a very inexpensive home, the total cost may be 5% or 5.5% of the value of the house. If you have an expensive home, $1 million, maybe the costs are only 2.5% of the value of the house, because there are fixed costs that that just change those numbers. But the number one cost associated with this loan is the mortgage insurance premium that's financed. They don't have to come out of pocket. That goes to Uncle Sam. Okay, it's really the magic behind the loan. No lender could make this loan without the backing of Uncle Sam. The way I've explained the product, because we wouldn't know how to manage that risk. So what happens is, and you folks are business people. What happens if we have the actuarial outlier over 100 in the house? Sequence of return. The real estate market is bad when a maturity event happens, and that $1 million house is now an $800,000 house, but the client owes $1 million. Who? If the lender just lose that $200,000 negative equity in that scenario, and we make a claim to Uncle Sam and we get paid, we get made whole. Uncle Sam does not make the loan, but they back the loan. Now that's an extreme scenario, but usually what would happen is the house worth $1 million. Someday it gets sold for 1.3, 1.4, 1.5, and the reverse mortgage gets paid off. The equity is released to the heirs or to the homeowners, the sellers. Yeah, I hope that answers the question.
Change today that we talked about where the purchase for those costs now?
Yeah. So Jerry just brought up a good point. For the better part of me in this space for 20 years now, in the reverse space, no seller concessions were allowed. Now they're allowed as of the last month, actually less than a month, just a couple of weeks ago. FHA commissioner announced that. So
What percent of the price can you get as a credit?
yeah, 6%. Yeah, 6%. So it used to be none. And the reason that we weren't allowed to use seller concessions is because it's a protected class, and FHA HUD did not want people to select this loan product for purchase because it had bells and whistles that were confusing. Oh, they're paying my closing cost, I'll pick this one. No, they wanted us to use the strategy, or the client to use the strategy, because it was the best strategy for them. So they said no bells and whistles, no seller concessions. But we've been lobbying HUD for so many years that they finally said, okay. They're like, it's just not fair. We have these lot of boomers buy a new home, and especially if you're going to these states where these Del Webb communities and the such, they all have concessions. They lose them with reverse financing. Not anymore. That's a really good point. That's brand new.
Another thing, in the event the senior passes and they're underwater on the house by any amount, 200,000, 500,000, it's not probably going to happen. And they have $1 million asset that they've left to their kids. The non-recourse piece, if you could explain that, just means the heirs still get that asset. They never go after any assets of the borrower, even if the borrower is underwater. The people that are inheriting that asset get it. They don't deduct the loss, and then they get it. They get the full boat, right?
Okay, let me make it very personal to answer that question. We all know that my mom has a reverse mortgage. My dad took it out with her. He's gone for 4.5 years now. He died just before COVID. I'm so glad for that, because he would have hated that, right? So anyway, so my mom is getting that tax-free income from that reverse mortgage credit line, which means it's going to be impossible for my mom, just taking the required minimum distribution at her age for their existing dad's leftover IRA, for it to go down to zero. So if my mom lives to be a very long time, 100 in the house, and if someday her loan balance on her reverse mortgage is greater than what the house is worth, your scenario, that means it's non-recourse to my sister and I, even if my mom still has $500,000 in the IRA that we inherit. If the house is underwater by 100 or 200,000, and she's got $500,000 left to my sister and I, guess what? We get that. That's non-recourse. That's fully forgiven.
And they can do that because they're paying the mortgage insurance, really.
Well, because it's FHA insured.
Right.
Yeah, it's 2%. So the question was, what about the closing costs? It's 2% of the value of the house. Look, the fund is in really good shape right now. It used to be 2.5% of the value of the house. It's come down by 20%, from 2.5 to 2. That's a 20% reduction. And the ongoing MI that gets there's two components: there's the upfront MI, there's the ongoing MI, just like a regular FHA loan. The ongoing MI has come down by a whopping 60%. It used to be a 1.25% add-on to the interest rate. It's only a 0.5% add-on to the interest rate. My mom got it a long time ago when it was 1.25% add-on, but we're not touching it because she doesn't need to refinance it. We're just leaving it. So she's paying 1.25% annually on her MI. But all of that money goes to make the fund healthy. And look, when you have assets under management, that's 1% per year. Our big one is 2% one time. Okay, and then the ongoing is a 0.5% per year. Okay, someone's got to take on this risk to backstop it, and it's Uncle Sam. It's not the taxpayer. You say Uncle Sam is the taxpayer. Uncle Sam has this fund. Uncle Sam has this fund. Yes.
To that point, interest rates being, let's say, 8%.
Yeah.
And someone takes out a reverse mortgage
Mhm.
and they come down to 5%.
Mhm.
Is that something you refinance or
You can, but if you have the credit line product like my mom, it refinances itself as the rates come down. Well, she got it when interest rates were in the dirt, and the rates have gone up over time. But for the long duration of the loan, the first 7 years, she didn't have a loan balance, so it didn't matter what the interest rates were. Okay, but if the interest rates rise, the line of credit growth rate rises with it. If the interest rates go down, the line of credit growth rate decreases with it. It's a very clever. Yeah, all HELOCs are adjustable. All HELOCs are adjustable. You can get, any credit line, a line of credit by definition is an adjustable rate line. And we have caps. Most credit lines have like 10, 12% caps. Our caps in reverse are even better. They're 5% over the initial start rate. So if someone started at 3, the max they're going to get is 8, even if it goes to 16%. So here's my very last thing for you. And then I apologize, Jerry, because I haven't figured out how to use this thing. I'm dumb as nails today. It's backwoods in North Carolina. You know what? My clicker is opposite. Yep. So or I was probably holding my clicker upside down. Yep.
So the closing costs to get the HELOC
Mm-hmm.
or to get the reverse mortgage, can those be financed?
It's all financed. Yeah. The only thing that's not allowed to be financed is the cost of the consumer counseling session. And because the lender's not even allowed to arrange it. That's how serious HUD is. They want the client to have an unbiased counseling session. So we just give them a list and call whatever counselor you want. They can do it by phone. It's usually about $150. And that's the only thing that can't be financed by the lender. But they can call the counseling agency and ask the counseling agency, could you be paid at the table? Are you willing to finance it? And they say, many of them say yes. But yeah, you don't have to come out of pocket for any of this. But it's still your money. It's your equity, right? It's going to. When my parents took out the reverse mortgage when their house was free and clear, the credit line, they didn't take a draw, but they did roll in their initial closing costs. And that's all they did. And then they let the credit line grow for 7 years. Oh.
In our area, right in downtown, Stockton, on the board.
Oh, yeah, you can do it face-to-face. That's great. Yeah, most clients choose to do it over the phone because a lot of local face-to-face options are not as available, but I'm glad there's one in your market. This is kind of cute. So my mom, as you all know, she gets the monthly income tax-free. Dad stroked some money out of the account for a check to buy her a nice car that should last her the rest of her life. And then my mom used it one other time. She bought one of these Generac generators. I said, Mom, that's like $15,000, $16,000. She goes, I know, but we live in southeastern North Carolina, which is Hurricane Alley. She's the only person I know that's so disappointed we haven't had a serious storm in the last few years because she wants us all to come over and eat.
Yeah, exactly.
Yeah, it's true. Okay.
We have a generator.
I'm going to leave you with this. This is another real deal. Okay. This is the last little cherry on top, folks. This is a real client, different picture, 57. His name is not Brian. He is in California, Santa Barbara. And by the way, folks, not him. I've been relegated for the better part of my reverse career doing most of my business in North Carolina with a small extended footprint, a few other states, South Carolina, Virginia, Florida. Now 50 states and the District of Columbia. We can do these. Santa Barbara is a different place. We just did a reverse mortgage on an $18 million home, and that was the lower of the two appraisals. The first appraisal came in at $20 million, the second came in at 18, and the first draw request was for $3.5 million. This is not my grandmother's loan, okay? And the lady was like 61 years of age. You all said 62, okay? Brian's 57. This is not an FHA home equity conversion mortgage. This is a portfolio reverse mortgage. Guaranteed rate. It's a very, very niche business. We have investors that we work with that we carry some portfolio loans. May not apply to the average market in Algonquin, but there are opportunities. You never know, okay? Brian, what did Brian do? He's 57. In most states, you have to be 55. In Illinois, you have to be 55 to qualify. There's no protected non-borrowing spouses. There's no FHA backing. So the investors, the lender, takes on all the same non-recourse risk itself. But we take on this risk, okay? And so there's no mortgage insurance. There's no ongoing mortgage insurance. There's no upfront premium. They pay for it in the rate. The rates are higher. The rates on these loans right now are like in the 9% plus range. Okay, but what did this guy do? Brian, single man, California, Santa Barbara, wants to buy a new home. Folks, his old home was $1.5 million. I don't know for sure. I think Brian had inherited that and was living in it. I think it was his parents' home. Now he has it. It's free and clear, okay? And so this is a starter home in Santa Barbara. It's a starter home, okay?
Wow.
It's a different world, okay? And so we use the transaction cost, $120,000. He walks away with $1,380,000. He's upsizing to $1.8 million, a step above a starter home in Santa Barbara, okay? I mean, we just did an appraisal for $18 million there, okay? So he's now short $420,000. This was not my personal client. I do not know what his overall financial picture is or was, but I do know under this option, he's short $420,000. So what can he do for that $420,000? He can dip into savings. He can hit his retirement account. He can get a loan if he qualifies for a loan. What do you think he did? He got a jumbo, we call it jumbo portfolio reverse mortgage. He upsized the same numbers. He liquefied just shy of 1.4, same thing here. The purchase price is 1.8. At his age, 57, he qualified for that amount, $536,000. Okay, so he took 1.2 million plus from the sale, okay, from the net proceeds, and he made that big down payment. Right here, he made that big down payment. But instead of being 420 short, he added 116,000 and some change to his piggy bank. Okay? Now the difference is he's got a mortgage. He's got a mortgage with a pretty high interest rate. But he's able to move into a $1.8 million house that he wants. And if I'm Brian, I'm thinking, I'm 57, that's the house I see myself staying in. Why else would he do it? Okay? It's not a magical loan. It's not a free giveaway. There are trade-offs. The trade-off is he could have stayed in this house and had it free and clear. But now, who knows what's going to happen in California? Is Santa Barbara going to continue to go up? Or is somebody going to one day say, you know what, this is crazy. There's a mass exodus of people leaving California unless things change. They're going to markets like Texas. There's a lot of people leaving some parts of Illinois as well. So he tapped out here. He got the house he really wanted. He has no more risk, especially if this is a long-term keeper. This is probably, and I hear this a lot, the proverbial carry me out in a pine box house, right? I'm done. This is where I'm going to stay. He doesn't have a mortgage payment, and he added to his savings, and he's not borrowing any more money.
So you're saying use a reverse, but he's just over 55, so
Yeah.
he's not 62.
Right?
But this is the portfolio jumbo.
Yeah.
So a younger person can get this reverse loan.
Yep. But there's just things that we're trained to know. If the younger person has a non-borrowing spouse that's under 55, they're not going to be protected, right? So if something happens, they have to have another plan. So we're trained to know not to step in a minefield. We want to counsel people well. We don't want to just, right? But for him, single guy, he moved into the house. He got the house that he wanted. He didn't go big relative to where he was, but everything's relative, right? But that's a lot of money to come up with, whether you're borrowing it or taking it out of cash. Who knows what he has? I don't know his overall financial picture. What I do know, he's got an over, like a $550,000 swing roughly. He needs 420. Here he gets 117-ish. So,
We all need bigger houses.
we're very much we have a big lending footprint. So that's not that big of a deal in where I live, unless it's like Wrightsville Beach, which is a very, very small community. But in some markets in Florida and in California, we do see this, Connecticut, Massachusetts, some markets. Okay, My last little piece of the puzzle for you folks is nobody knows about what I'm about to show you. This is where you use a reverse purchase money loan to buy a duplex, triplex, or quadruplex, occupy one of the units as your own, and free cash flow the other units without having a mortgage payment. Yes, you can buy a home, get a mortgage, go into debt, not have a mandatory monthly mortgage payment, and rent out the other units for maximum free cash flow. You mean I can increase my income in retirement by doing this? I don't want to live with other renters attached to my home. Don't do this strategy. This is allowed, okay? So here's the purchase price, $700,000. 81-year-old couple, $700,000. They sold their former home. They have $500,000, okay? They're going to buy this duplex for $700,000. They've got to put $200,000 into the transaction. So they're borrowing $500,000 on a reverse mortgage, okay? On a conventional loan, okay? So their mortgage payment is just call it $3,400 a month, okay? They're going to rent out the other side for $1,500. The key is they have to be occupying one of the units as their primary residence. You're allowed to have up to 4 units if you occupy one of them. So their mortgage payment minus their rental income is $1,926 a month. Okay, so this is not a bad way to go, right? They have rent to offset their mortgage payment. What they did, which is better, is they came up with $350,000 for their down payment. They paid, remember, about half. There it is. There's your half because they're 81, and they got a reverse mortgage for $350,000. Now, instead of having a mortgage payment for $3,400, they have no mortgage payment and they're collecting $1,500 a month rent. That's a total swing of $4,926 a month. And instead of getting a conventional loan with a payment, they added $125,000 to savings because they didn't need, here they're coming up with $200,000. Here they had to come up with $350,000. So they put more money into the transaction. See? They have a massive swing, almost $5,000 a month. That's by renting out the other side of the duplex for $1,500. Arguably, rents are higher than that, but we try to be conservative when we go over these examples. Okay, so really, really neat stuff, folks. You all have been wonderful, putting up with me, listening for this amount of time. I personally have the attention span of a gnat, so I commend you. It's very much a privilege to come and talk to other professionals. Very serious about what I'm about to say. Time is a non-renewable resource that we all have in common as human beings. And so I very much respect your time and appreciate you for investing some of your time with us here today.